Hello everyone and welcome to this video on the Python programming language. So in this video I'm going to show you all how to create a Python program for finance. So this program will show you how to compute portfolio simple returns, get daily returns, volatility, etc. Things like that. Alright, so I'm on Google's website called colab.research.google.com because it makes it really easy to get started programming in Python. So you don't have to install Python onto your computer. You could just go to this website and then log in using your Google account and get started writing your Python code. So let's go ahead and get started writing our program now. So the first thing that you're going to want to do is click on File and then click on New Python 3 Notebook, where a new tab will open up for you and a new cell. And before I write any logic for the program, I want to put a description and comments about the program. So let's go ahead and do that now. So here I'm going to put description, and this is a Python program for finance, and this program will show you how to compute portfolio simple returns, get daily returns, and volatility. Okay, etc. All right, so let's go ahead and start programming. Well, let me go ahead and bring this down one level here. All right, so let's go ahead and create a new cell by clicking this code button. And in this cell, I want to import the libraries that we're going to be using throughout this program. So from datetime, I want to import datetime. Then I want to import numpy as np. Next, I'm going to import pandas as pd, and I'm going to import pandas underscore data reader as web, and I will import matplotlib.pyplot as plt, and then we'll give our plot a style. So just type plt.style.use, and we will use the 538 style. Okay, so next we're going to run this cell by clicking this button here, and hopefully there are no errors. Okay, everything looks good. I'm going to just scroll this up a little bit, and we will create a new cell. Now, I should probably explain to you all my thinking for this program. So we're going to create a fictional portfolio. So this is not financial advice. So we're going to get our stock symbols that we want in our portfolio. We're going to get the starting date for the portfolio. And then we're going to get the end date for the portfolio, which will be whatever today's date is. And then we're going to start doing some analysis and some graphs, then computing simple returns, daily returns, things like that. So let's go ahead and continue here. The first thing we'll do is get the stock symbols for the portfolio. And I'm going to use FANG for the portfolio stock. And for those of you who don't know, FANG, spelled F-A-A-N-G, is an acronym for the market's 5 most popular and best performing tech stocks. So that's Facebook, Amazon, Apple, Netflix, and Google, even though Google's parent company is Alphabet. All right, so I'm going to create a variable called stock symbols, and I'm going to set it equal to an empty list. All right, so now I'm going to input the stock symbols. So FB for Facebook, and AMZN for Amazon, AAPL for Apple, NFLX for Netflix, and GOOG for Google. Okay, and then I'll go ahead and run this. Okay, so now we have our stock symbols. Let's create a new cell. In this cell, I'm going to get the stock starting date. So I'm going to create a variable called stock start date, and I'm going to set it equal to 2013-01 for January, and then -01 for the 1st. So this will be January 1st, 2013. And let's run this cell. Okay. Now you may be wondering, how did I come up with this arbitrary date to start our portfolio? Well, I'm starting this portfolio at this date because of Facebook. So Facebook did not have an IPO, or a initial public offering, until mid 2012 sometime. So I wanted to start it off in the next year to get that full year of data worth of data for Facebook. So that's why I came up with this, or that's how I came up with this starting date. All right. Okay, so let's go ahead and create a new cell. And in this cell, I want to get today's date. So this will be the ending date for our portfolio. And once I get the date, we're going to have to format it. So we will format it in the form year with 4 digits, so YYYY, then month with 2 digits, so MM, and then the day with 2 digits, so that's DD. So I'll create a variable called today and set it equal to date time dot today dot strf time, and then here we'll put percent capital Y dash percent M dash percent D. Okay, and then let's print today. So let's run this cell. Okay, so that looks good. Let's go ahead and create a new cell, and here we will get the number of assets in the portfolio. So this would be pretty simple. I just want to print something like you have 5 assets in your portfolio. So those 5 assets are Facebook, Amazon, Apple, Netflix, and Google. But I want this to be a little bit more robust. So let's create a variable called num assets and set it equal to the length of the stock symbols. Okay. And then what we can do is we can append num assets as a string to this print statement. So I will do that. So instead of us just explicitly putting 5 here, we'll put num assets there as a string instead. So str num assets, and then another plus sign, and then the quote, or yeah, quote. So that should do it. Let's run this. Let's see if we get the same result. And we do. So that's excellent. So if I were to get rid of one of these stock symbols, then the number of assets should also decrease. All right. So let's go ahead and create a new cell. And in this cell, I want to create a function to get the stock prices in the portfolio, or yeah, in the portfolio. All right, so let's go ahead and create that function. I'm going to call it get my portfolio, and it's going to have a parameter called stocks, and I'm going to set that equal to the stock symbols that we created up top, and then it's going to have a start date. So I'm going to create a parameter called start and set it equal to stock start date. Next is going to have the end parameter, and this will contain the end date, which is today. And then I'm going to create a parameter called call, which will be short for column, and I'm going to set it equal to the adjusted close column, because I want the adjusted close price for our stock. Okay. All right. Next, I'm going to create a variable called data, and I'm going to set it equal to web.data reader, and it's going to take in stocks, and then we need to give it a data source. So the data source will be Yahoo, and we need to give it a start date. That will be start, and we need to give it an end date, which will be end as well. Okay, and I said I only want the adjusted close price. So here I could put adjusted close, but I want this function to be more robust. So I'm going to put just call here because maybe we input just the closing price, or maybe we want just the open price. So we'll get whatever column we want here. And of course, we have to return data. All right, so let's go ahead and run this cell. And let's create a new cell. And now let's get the stock portfolio adjusted close price. All right, and we're going to store it into a variable. So I'm going to create a variable called my stocks, and I'm going to set this equal to get my portfolio, and we're going to input stock symbols. Okay, and then let's show my stocks. So let's run this. Excellent. So now we can see the adjusted close price for each one of these stocks, for each one of these companies. So what's pretty interesting is on January 2nd, 2013, Facebook stock was worth $28. And as of January 27th, 2020, Facebook stock is worth $214 and about, I'll round up, say 87 cents. Okay, it's really 214.869995. So that is pretty interesting. We can see that Facebook stock increased over time from January 2nd, 2013. And as I look at these numbers here, going back and forth from the start date to the end date, I see that all of the stock prices for each of these companies has increased. So already is looking like it's going to be a pretty decent portfolio. All right. So let's go ahead and create a new cell. All right. Now in this cell, what we're going to do is create a function to visualize this portfolio. So let's put that in comments. So create a function to visualize the portfolio. All right, so I'm going to call this function show graph. And it's going to have a parameter called stocks, which will be equal to stock symbols. And it will have a start parameter, which will be equal to the stock start date, and a end parameter, which will be equal to today, and a call parameter, like in our last function, that will be equal to the adjusted close price. Okay, so that looks good. Let me go ahead and bring this up a little bit. Now I want this graph to have a title, so I'm going to create a title here. Create a title for the portfolio. So I'm going to create a variable called title, and I'm going to set it equal to portfolio adjusted close price history. All right. And again, I want this function to be robust like the rest of the program. So we don't really want just to say adjusted close price all the time. We want to append call. All right. And that looks good because again, call could be the open price, it could be the close price. So we'll just make this a little bit more robust for whatever our needs are in the future. Okay, so next I'm going to get the stocks. So I'm going to create a variable called my stocks within this function, and we're going to use the function get my portfolio, and we'll input the parameter stocks equals stocks, start will equal start, end will equal end, and call will equal call. Okay, so that looks pretty good. Now let's go ahead and give our plot or chart a size. So uh, give the figure size. Okay, so in order to do this, just type plt dot figure, and within that parameter or within the parentheses, put fig size equals, and we'll put 12.2 inches for the width and 4.5 inches for the height. And next we need to loop through each stock and plot the price. So in order to do this, we can use a for loop. So just type for c in my underscore stocks dot column with a s, columns dot values. All right, and I need to bring this up a little bit more. Okay, so how are we going to apply each of them? Just type plt dot plot, and within this or within these parentheses, just type my underscore stocks and then left bracket and then C and then right bracket. All right, and then we'll give each one its label. So label will be equal to C. All right, so that looks good. Next, let's go ahead and add the title to the plot or to the chart. So just type title here. And let's give our x-axis a label. So just type plt dot x label, and the label will be date for the x-axis, and we'll give it a font size equal to 18. Next, let's give our y-axis a label. So just type plt dot y label, and it will be the adjusted close price United States dollar, and then we'll put a little dollar sign just to make it look good, and we'll give it a font size equal to 18 as well. And of course, I'm going to change this adjusted close price to be call. So we're just going to pin call. All right, that looks good. Next, let's go ahead and add a legend to our plot or chart. So type plt dot legend and input my underscore stocks dot columns dot values, and we need to put this in the upper left location. So type lock equals upper left, and then we want to show this chart or plot or graph. So plt dot show. All right, so hopefully I didn't make any mistakes here. Let's go ahead and run this cell. All right, let's create a new cell, and in this cell we want to show the adjusted close price for Fang. So just type show graph, and then we'll input the stock symbols, and then we will run this cell. Okay, so no errors. Now this graph looks really good. So before we saw the prices for the portfolio, but now we can visualize them. And so we can see that we could have bought some stock in 2013, and in 2020 those stock prices would have increases or would have increased for the adjusted close price. So it's pretty interesting. Also, what we can see is that Amazon stock between the year 2018 and 2019 was above $2,000. So that's pretty crazy. And the same thing for Amazon's price between the year 2019 and 2020. So there's just some interesting ways to look at this stock data. So I like it. The chart looks good. Let's go ahead and create a new cell. And I'll scroll up. Now in this cell, we will start doing some calculations. So let's calculate the simple returns. Okay, and this is pretty simple. So to calculate the simple return, you could just take the new price divided by the old price and then subtract 1. So again, let me say that one more time. To calculate simple returns, simple daily returns, you can take the new price, so for the current time period, the new price of that time period divided by the old price of that time period minus 1. And that's exactly what we're going to do here, but really we're going to have Python do it for us. So let's go ahead and create a variable called daily underscore simple underscore returns, and let's set it equal to my underscore stocks dot pct underscore change, and we can input 1 for 1 day, and then let's show the daily simple returns. So just type daily underscore simple underscore returns, and let's run this. Okay, and so now we get back our daily simple returns here for each day for each stock. Okay, and again, to calculate this, I can go ahead and show you actually. So we can take the price. Let's take Facebook for example. We see these 2 days. So Facebook old price will be 28 and Facebook new price will be 27.77. So let's do that calculation here. So we're going to take the new price, which is 27.77, and we're going to divide it by the old price, which was 28. And we're going to take all of this and subtract 1. And let's see what we get. So we get negative 0.0082142857142857.3. And you can see that we get that same number here, albeit that it's rounded, but that's the same number here. Okay, so that's how Python is doing these calculations for us automatically. All right, or at least that method is. So let me just get rid of that. So that looks good. Let's go ahead and show the stock correlation. So in order to do this, just type daily underscore simple underscore returns dot CORR, the left parentheses and right parentheses. So we'll run this cell, and now we can see the stock correlation. And correlation is used to determine when a change in one variable can result in a change in another. So a correlation value of 1 means two stocks have a perfect positive correlation. So you can see, and you will see, a 1 on the diagonal here. All right. And if one stock moves up while the other stock goes down, then they would have a perfect negative correlation. And that would be noted by the value -1. All right. So I think that's good. Now let's go ahead and create a new cell. And in this cell, we will show the covariance matrix for simple returns. So let's show the covariance matrix for simple returns. All right, so in order to do this, just type daily underscore simple underscore returns dot COV in the left parentheses and right parentheses and run this. Okay, so now we have the covariance matrix. So what are we looking at here? Well, the diagonal entries of the covariance matrix are the variances. So here, 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 and here. And variance in statistics is a measurement of the spread between numbers in a data set. So it measures how far each number in the set is from the mean and therefore from every other number in the set. So the higher the variance of an asset price means the higher the risk the asset bears, along with a higher return and a higher volatility. And the lower the variance of an asset price means the lower risk the asset bears, along with a lower return and a lower volatility. Okay. Now, every other, I guess, point or every other area, except for the ones on the diagonal, are the covariances. All right. And I should also note that covariance is a very important measurement used in modern portfolio theory. And modern portfolio theory attempts to determine an efficient frontier. And the efficient frontier is basically the set of optimal portfolios that offer the highest expected return for a defined level of risk, or the lowest risk for a given um, for a given level. I'm sorry, yeah, for a given level of expected return. Okay, and I guess I should mention that the efficient frontier tries to optimize the maximum return versus the degree of risk for the overall portfolio and for all the assets in the portfolio. Okay, so for the overall portfolio is, I guess, the right way to say it. Okay, so anyways, I know that's a lot. Let's just continue on here. I agree that's a lot, and you can find more about it online, like I was able to. So let's continue. Okay, so next thing that we're going to do is show the variance. And you may say, well, we just saw the variances, right? And we did, but maybe you don't want to create a covariance matrix to see these variances. So here's another way you can see them. Just type daily underscore simple underscore returns dot var, then left parentheses and right parentheses, and then run the cell. And we can see that these numbers match up pretty well. So this is just another way of showing the variance. All right, so let's go ahead and create a new cell. Now in this cell, I want to show the stock volatility. So we're going to print the standard deviation for daily simple returns. All right, so I'm going to print the stock volatility. Let me make this a capital S, stock volatility. And yes, volatility is standard deviation. So just type daily underscore simple underscore returns dot std and then left parentheses and right parentheses, and let's run this. Okay, so here we go. We have the stock volatility, and we can see that the most volatile stock is Netflix, and the least volatile stock is Google. Okay, and again, the higher the volatility, the higher the return, and the lower the volatility, the lower the return. So we would expect a lower return for having Google as opposed to having Netflix in this case. Okay. All right, so let's go ahead and create a new cell, and I'm going to bring this on up, and here we're going to visualize the stock's daily simple returns. Okay, so let's give our plot or figure a size. So we just type plt dot figure and then fig size, and it's going to be equal to 12 comma 4.5. So that's 12 inches wide and 4.5 inches high for the chart. And then we're going to loop through each stock and plot the simple returns. So again, we can use a loop. So for C and daily underscore simple underscore returns dot columns dot values, we're going to plot our data. So I think before, um, anyways, let's see. We can do the x-axis and y-axis this time, as opposed to what we did earlier. So I can just put daily underscore simple underscore returns, then the left bracket C, and then the right bracket. We can give this a line width, so LW, and I'm going to just choose some arbitrary number like 2, but we don't have to have the line width, of course. I'm just being a little bit more fancy with this chart as opposed to the one we had before. And we'll give it a label, and it'll be C, and then I'll come back and show you all something else you can do when you're creating your charts. Nothing mind-blowing, just showing different ways to do things. All right, so anyways, we will go ahead and create a legend. So type plt.legend, and we need to give our legend a location. So we're going to locate it in the upper right, and we'll give it a font size. So font size will be equal to 10. Then we will give our chart or graph a title. So I'm just going to call it volatility. And I guess I should also put visualize the stock's daily simple returns slash volatility. Okay. Next, let's give our x-axis a label. So we just type plt.x label, and it will be the date. And let's give the y-axis a label as well. So plt.y label. We will call the y-axis daily simple returns. Okay, and then we will show this chart. All right, so let's run this. Okay, so now we can see that we get back this interesting chart here, and I want to show you all that we can add in the x-axis here if we wanted to. So I could type daily underscore simple underscore returns dot index, and it should give us the same thing. So let's see, let's run this. Okay, so I'm just showing different ways you can basically make your chart, but it's really the same result. Anyways, we now have our graph, and it looks pretty good. So we can see from this graph or chart the daily simple returns on the y-axis, and we can see the dates here on the y-axis. And we can also see that Netflix seems to be very, very volatile, and also Facebook as well. So that's, here and here we can see Facebook stands out, and we can see Netflix stands out here, here, it stands out here, and here. So visually, you can kind of see which stock is more volatile. And then if you look for Google, Google seems to be like right here in the middle. So it doesn't seem that volatile from this chart. Okay. So I think that looks good. Let's go ahead and create a new cell. And in this cell, I want to show the mean of the daily simple return. So in order to do that, we just have to type daily underscore simple underscore returns dot mean, and then left parentheses and right parentheses. And you know what? I'll go ahead and set this equal to a variable. Let's create a variable and let's call it daily mean simple returns and set it equal to that. And then we will print the daily mean simple return. So just print the daily mean simple return. And then we'll print it daily mean simple return, or returns with an S. And actually I want this R to be capital and I want this R here to be capital. So let's run this. Okay, so now we can see the daily mean simple returns. So that looks pretty good. So we can expect about a 0.001351 return on Facebook daily. We can expect about a 0.001273 return on Amazon daily. We can expect about 0.000968 return on Apple. And what we have already figured is that the highest return should be for Netflix. So let's see if that's the case. And indeed, that is the case. And the lowest return should be for Google. And that's the case here as well. So now we can just see, basically how much more of a return we'll get from Netflix compared to the rest of them. All right, so let's go ahead and create a new cell. And now let's calculate the expected portfolio daily return. So we need to give our portfolio some weights now. So I'm going to create a variable called random weights, and I'm going to set it equal to np.array. And what we're going to do is we're going to give about 40% of our portfolio to Facebook. We will give, I go with 10% to Amazon. We'll give 30% to what's the next one? Is it Apple? So AAPL. We will give 10% to Netflix in FLX, and I'll put a space between these. And we'll give 10% to Google. All right, so let's go ahead and create that array. So just type 0.4 and then comma 0.1 comma 0.3 comma 0.1 comma 0.1, and it should add up to 1. So let's see, 0.4, 0.5, 0.8, 0.9, 1. Okay, perfect. All right, now I'm going to create a variable called portfolio simple return, and I'm going to set this equal to np.sum, where we're going to sum up the daily mean simple returns, and we're going to multiply them by random weights. Okay, so that should do it for our portfolio simple returns. Let's see, we're summing daily mean simple returns times random weights. Okay, so that looks good. Let's print the expected portfolio return. So I'm going to put a print statement here, and I'm going to say the daily expected portfolio return is, we're just going to append portfolio as a string, or portfolio simple return as a string, and then we're going to run this cell. Okay, so with this portfolio of us owning about 40% Facebook, 10% Amazon, 30% Apple, 10% Netflix, and 10% Google, and that's not 10% of the stock, that's just the percentage within our portfolio, we can expect about a, let's see here, point 0.127 percent return daily on our portfolio. So that's pretty good. That's really not bad. Let's go ahead and calculate the yearly portfolio return. Okay, so I'll put that in comments here as well. Get the yearly simple return. So we can just print the expected annualized, right? Because it's going to be yearly. So expected annualized portfolio simple return. I can just append the portfolio simple return as a string multiplied by 253. Okay, and you may be wondering, why did I multiply this by 253 as opposed to multiplying it by the number of days in a year, which is 365? And the reason why I did this is because this year there will only be 253 trading days, and I say only, but it will be 253 trading days. I think in 2018 it was 252 trading days. So this is why I'm multiplying by 253. And if you do the math, I think the number of trading days come out to something like 252.75 days. So, anyways, um, I'm going to use 253 here for our annually expected portfolio return. So let's go ahead and run this cell. Okay, and we can see that we expect about 32.14. I'm just going to round that up to 4. So about 32.14% return on our investment for a portfolio with these weights and with these stocks. So that's pretty cool. All right, so let's go ahead and create a new cell. And I'm going to bring this on up a little bit. All right, so now I want to calculate the simple return. Wait, no, we've already calculated simple return. I want to calculate the growth of our investment. Calculate the growth of the investment. So what do I mean when I say I want to calculate the growth of our investment? So I want to calculate the total returns from our investment. And to do this, we need to calculate the cumulative returns. So let's go ahead and do that. So we're going to calculate the daily cumulative simple return for this period of time. And this is pretty simple actually. All we have to do is just type daily underscore simple underscore returns plus 1 dot cumprod, cumprod. Okay, then left parentheses and right parentheses. And I'm going to actually set this equal to a variable. So we're going to say daily daily let's say cumul simple, so SIMPL return. I need to come up with some better variable names than this, but daily cumulative simple return is what this is short for. And then we should show the cumulative cumulative simple returns. All right, so in order to do that, just type daily there we go, daily cumulative simple return. All right, so let's run this. We have our daily cumulative simple returns. And now you may be wondering, well, how did I, or how do you calculate daily cumulative simple returns? And it's pretty simple. We are just going to take, and I'm going to create a new cell here. We're going to take some period. We'll call it period 1 plus 1. And then we're going to multiply that by the next period. So we'll call it period 2. And of course, that's plus 1. So let me put these in parentheses. All right. So this is how you calculate cumulative returns, but you're going to do this for the whole period of time. So all the way up to period, we'll call it n for the end of the period plus 1. All right. All right, so let me give you an example. So just in case, because I'm not really satisfied with this, I guess, equation. So let's take, for example, the daily underscore simple underscore returns of Google at position 1, and let's add 1. Okay, and then we're going to multiply this by basically the same thing, but at position 2. Okay, and I'm just going to put this in comments here, and let's go ahead and run this. Okay, and you see that we get back 1.020352, and that's the same number that we got here. Okay, and the daily simple returns we got much earlier during this video at the top here. So you can see Google's daily simple returns. So if you multiply this plus 1 by this plus 1, then you come up with the result that we got here at the bottom, which is 1.02035255, so on and so forth. All right, so I am done boring you all with this math. Let's go ahead and delete this cell. I'm going to go ahead and create a new cell. And now let's visualize the daily cumulative simple returns. So of course we're going to give our figure a size. So I'm going to type plt.figure, and then fig size is going to be equal to 12.2, and then we'll have 4.5. Okay, and then we're going to loop through the data. So for C in daily cumulative simple returns dot columns dot values, we're going to plot this. So I'm going to plot the x-axis, which will be daily cumulative simple returns dot index, and then we will plot the y-axis, which will be daily cumulative simple returns. Did I misspell returns somewhere? It should be returns, right? Not that, with an S. Let me double check. Oh, it's just I didn't put an S here. So I'll leave it like that. No S. And here, no S. Oh, because I put daily mean return. Okay, so daily cumulative simple return. All right, there we go. At C, and we'll go ahead and give it a line width, just 2, and then label will be C. And then we will give this a legend. Location will be upper left. I'm going to give it a font size. I'm just being fancy now. All right, font size will be equal to 10. We will give it a X label. So that's going to be date. And we will give the y-axis a label. So this would just be the growth of a $1 investment. And then we'll give it a title. So type plt.title, and we'll call it daily cumulative simple returns. And then we'll show this chart. So let's run this. All right. And now we can see what company would have given us the most returns. But again, we knew that it was going to be Netflix, but now we can see that. So we had invested $1 in Netflix in 2013 and sold it between 2018 and 2019. Up here, we could have gotten 30 times as much money we had invested into Netflix. So that's pretty interesting. And let's see, for Facebook, it looks like we would have gotten a little bit between 5 and 10 times more on our investment had we invested $1 into Facebook back in 2013 and sold it in 2020. And the company that would have given us the least money back would have been Google. And we can see that if we had invested $1 here in Google in 2013, we would have gotten less than um, $5 back, or less than 5 times as much on our investment. Okay, so that is basically it. I hope you all enjoyed this video. I will leave the code in the description below. Please leave any questions you have. I try my best to answer them, but I don't always get to the um, comment section. But if you enjoyed this video, please share it. Maybe others will enjoy it as well. And thank you for watching. And as always, I will see you all in the next video.